Hey guys, in this video, I'm going to show you exactly how you can invest your first $1,000 in the stock market. Now, the stock market is a great place to compound your wealth over the long term, but it also can be really intimidating for beginners. So in this video, I'm going to break it down into simple terms about the two different ways that you can invest in the stock market and how you can get started in either of those ways. Leave a like on the video if you enjoy this and let me know your thoughts down in the comments section below. But for now, guys, let's jump into it. So the first thing you're going to want to do is to work out whether or not you want to be an active investor or a passive investor. Now, you don't have to exclusively be one or the other. You can be a combination of both, but you do need to make a determination about whether or not you're going to go completely passive or whether or not you're going to dabble into the active investing space. So let's first define what passive investing is and what active investing is. So active investing is where you're going to be actively going out and trying to beat the market. So you're going to buy individual businesses. You're going to dive deep into those businesses, analyze them, analyze their cash flow and their balance sheets and what's going on in those individual businesses. You're going to work out how much cash they can provide for you over the next 10 or 20 years. And then you're going to work out how much you're willing to pay for those cash flows. So if you can get back $1,000 from a business over the next 10 years, then maybe you would be willing to pay $100 for that business. On the flip side, you have what is called passive investing. And this is where you're going to be just investing in index funds. And an index fund is just an investment vehicle. It's like a stock on the stock exchange that invests your money into a broad array of businesses. So if you invest in an index fund that tracks the ASX 300, like the Vanguard Australian Shares Index, then you're going to get a piece of the top 300 companies in Australia. And there's versions for the US markets, the Australian markets, and pretty much any market you could think of. And what this means essentially is that you're going to be tracking the market. So you're not going to be able to beat the market. You're essentially going to accept the market return. And the reason that you're willing to accept the market return is that over the very long term, over the 100 years of data that we have for the US and Australian markets, both of those markets have performed really well. And by really well, I mean somewhere between 8 and 10% per year on average over 90 to 100 years, which means that if you just invest your money in the Australian or the US markets through an index fund, you can, over the very long term, so if you keep your money in there for maybe 25 or 30 years or even more, you build it up like a retirement fund, then over the long term, you can expect to make between 8 and 10%, which is a really, really solid return. So as I said earlier, you can either be a passive investor or a strictly active investor, or you can have a combination of both, which is what I do. So I have a passive proportion of my portfolio, which is about 15 to 20% of my portfolio, which is in that VAS index, that Vanguard Australian Shares Index, and that is expected to return me about 8 to 10% over the very long term. So that's the foundation of my portfolio, and that's something that you can do as well if you're nervous about actively picking individual stocks, but that is what you want to do. So if you want to go out and pick actively invest in businesses, pick individual businesses, you've got to realize that when you're starting out, you're not going to be great at it. So it's good to have that foundation of a passive proportion of your portfolio there anyway. So if some of those individual picks don't work out, it's going to be fine because you have that proportion of your portfolio, which is over the long term, very, very likely going to go up at least 5 to 10%. Now, for the vast majority of people out there who are looking to compound their wealth in the stock market, those people are not going to have any interest in looking into individual businesses. And even if you have an interest in looking into individual businesses, it's not enough just to be interested in it. You have to be willing to put the work in. And when you're actively investing in businesses, there is quite a lot of reading and analysis that you have to do. A lot of people make it seem like picking individual stocks is as easy as reading the Wikipedia summary of that business and just sort of thinking, oh, that's a good business, that's going to do well. That's not enough to be successful over the long term. And if you're going to do that, you should just stick to passive investing because you're going to do a hell of a lot better by just copying the market and just getting the market return. If you're going to be actively investing, you need to have the willingness to put in the work. And by putting the work, I mean you need to analyze the industry in which the businesses that you're buying operate in and analyze them thoroughly. And you also need to read a hell of a lot about those individual companies. You need to read all of their annual reports, all of their financial statements. You need to read news articles, and you need to be constantly learning about those individual businesses so that you completely understand them and you have an accurate picture of where those companies could go in the future. So how should you get started? What is the first thing that you should do when you start to invest in the stock market? Now, whether or not you're going to be an active or a passive investor or a combination of both, I think that this is the smartest thing that you can do to get started, and that is to buy into an index fund. So your very first investment with your first $1,000, I suggest that you buy an index fund in either the US market, so tracking the S&P 500, or in the Australian market, so tracking the ASX 300 or tracking the ASX 500. And the reason that I suggest that you do this is because it gives you a chance to experience what it feels like to be in the market without having to make an individual stock pick straight away. Because in all likelihood, your very first individual stock pick is gonna be garbage. I know mine was. I pretty much I did a bit of research for a couple of days and I just picked this garbage company. Fortunately enough, it did quite well for me. But I would have been better off if I just bought into the index fund, and straight after buying that individual stock, that is what I did. And it does two things. One, if you want to be a passive investor, that's where you're going to be putting most of your money into an index fund. So you're going to be doing that anyway. So it just makes sense that your first investment is in an index fund. And if you're going to be actively investing in companies, then buying into that index fund gives you sort of exposure to the markets while you start to learn about individual businesses, because it does take time to, one, develop your strategy, and two, to sort of dive deep into some individual businesses and find really great investments. So now I'll just explain what you would do if you wanted to be a purely passive investor. And it's really simple. All you have to do is not give a damn about what is happening in the markets. And that's really important. So what you want to do is you want to pick a dollar amount that you can invest at a regular interval. So this is going to be different for everybody depending on how much money you're looking to invest. But let's say that you want to invest $1,000 every 3 months. So that's what you're going to do. Every 3 months on a particular day, write down whatever day you've picked, and you're always going to invest on that day every single 3 months. So 3 months go by, you buy $1,000. 3 months go by, you buy $1,000. And you do that regardless of what is happening in the market. It doesn't matter if we're in a raging bull market and you're worried about a recession. It doesn't matter if we're in the depths of a recession and you're worried that we're going to be in one for the next 50 years. It doesn't matter what is happening. You just buy it. And the reason that you have to do that is because what you're doing is called dollar cost averaging. And dollar cost averaging works if you can be strict on just making your investments at regular intervals no matter what is happening. Where dollar cost averaging doesn't work is where you try and time the market. So instead of going every single month, timing the market would be not investing because you think we're going to have a recession, or investing because you think that we're going to have there's going to be a bull run, or there's going to be a massive upswing in the markets. Trying to pick where the bottom and the top is. Don't try and do that because you will lose. Undoubtedly, because no one can time the market over the long term. You might do well sort of a couple of times, you might get lucky and you might outperform the market doing that, but over the long term, you're going to average out to losing because, one, you're making trades, which is costing you brokerage, and two, timing the market doesn't work. And that's been proven time and time again. So all you have to do is pick a regular amount, pick a regular interval, 1 month, 3 months, 12 months, 6 months, whatever you want it to be. Just make sure it's regular, same amount, regular, and just do it. That's it. Don't give a crap about what the market is doing. That's how you passively invest, and that's what I do with the passive proportion of my portfolio. All right, so that covers the passive investors, but some of you out there are going to want to be active investors. These are people who are interested in learning about individual businesses. Now, the first thing you're going to do is you're going to buy that index fund with your $1,000 and you're going to participate in the market. And then what you're going to do is you're going to need to develop your strategy, and you're going to develop your strategy over your lifetime. You're never going to stop learning about it. I haven't stopped learning about it. I'm still reading books about it every single week and just developing my strategy. And if I don't have new books to read about it, I'm reading old books all over again, just repeatedly. There's so many investing books that I've read like 2 or 3 times just to get, just to reiterate it in my head and make sure that I understand it correctly. Now, you can pick a wider range of strategies. You ask 100 active investors what their strategy is and they'll all give you different strategies. but the strategy that I use and the strategy that has worked for the greatest investors in the world. We're talking about Benjamin Graham, who founded this strategy all the way back in the 1940s. We're talking about Warren Buffett, which was the wealthiest man in the world for a very long time. I think he's the second wealthiest man in the world. His net worth is north of $70 billion. Who else have we got? We've got Seth Klarman, who's averaged 17% per year for the last 20 years. Peter Lynch pretty much uses this strategy, although he deviates a little bit. But all of these really, really successful investors use the same value investing principles that were originally taught by Benjamin Graham. And just to summarize this strategy, it's really simple. There's two parts. You need to find great businesses and you need to buy them on sale. And there's obviously a lot more complexities that go into finding it on sale and finding really great businesses. But once you understand the core of that strategy, really the hardest part is just putting in the work. Just reading more and more and more so that you understand the businesses really, really well. It's not that Warren Buffett has some secret formula or some secret tactic that he hasn't shared with the world. That's not why he's great. Why he's great is because he thoroughly understands the businesses that he's investing in. He said it over and over again. The reason that he's great, he says, is because he understands consumer behavior and he invests in consumer sort of businesses. Think of like Wrigley's gum, C's candy, I think it was. He's invested in Gillette razors. These are all like consumer related. Recently, he's invested in Apple. That's another consumer business. These are all businesses that sell products to consumers. And he believes that, or he clearly does because he's been so successful, he understands consumer behavior. And because of that, he understands what is a great consumer business and he can identify them. And he's also good at doing the valuation. But the valuation isn't the hard part. The hard part is putting in the work and understanding the businesses. And if you want to learn more about this strategy, I suggest that you hit subscribe and join the team. And if you're already subscribed, then check out tons of my other videos because I talk about this strategy all the time. And I think I'm one of the few people on this platform that are actually explaining sort of how this strategy should be implemented. A lot of people just talk about businesses. This is a great business. This is a great business. But no one is talking about the price. And that is really important. You need to value them and work out how much you need to pay because there is a specific amount that you can pay for these businesses. That means that you're guaranteed to make a great return. And really, when you're looking for these businesses, you're basically going to find about 5 to 20 different businesses over your entire lifetime. That's it. There's not many. You're going to study businesses and maybe you find one a year or one every 2 years. It might not be many at all, but when you find them, you're going to be investing in that same great company over many years. And you're only going to have a basket of stocks at a time because that way you can study them extensively and make sure that you completely understand your portfolio. Don't over diversify. A lot of people will say you need 50 or 100 stocks in your portfolio to be diversified. That's garbage. You only need to diversify if you don't know what you're doing and if you don't understand what businesses you're invested in. If you thoroughly understand the businesses you're invested in, you don't want to be investing in your 30th best idea or your 50th best idea. You want to invest in your top 4 or 5 or top 10 best ideas. Personally, I think I have about 5 stocks in my portfolio, not many at all. I think 5 is including the index fund, so I think there's 4 stocks in my portfolio, which means that every day I can study and see exactly what is happening with those companies. And I know exactly what is happening as soon as it happens because I don't have to look through news for 50 different companies. I just look at the news for my 4 companies. But that's basically it. I mean, if you want to be an active investor, go check out my channel where I've got detailed explanations of how to apply this strategy from start to finish. And as I said, there's those 2 different sections, great businesses at great prices, and that's it. So I hope you guys enjoyed this one, and if this video was useful for you, please leave a like and share it with a friend so they can find out how they can get into investing. Remember, investing is not just about people who are interested in individual businesses. If you just want to compound your wealth, be a passive investor and experience the growth of the economy over time. So I hope you guys enjoyed this one, and I'll see you in the next video.